the end of the 1990s, the world wasn't just optimistic. It was convinced. Convinced that it had finally solved one of humanity's oldest problems. Scarcity. For centuries, growth had limits. Resources were finite. Distribution was slow. Information was expensive. But suddenly, a new force appeared. The internet. And it didn't arrive quietly. It arrived wrapped in promises so large they felt almost uncomfortable to question. The internet wouldn't simply improve productivity. It wouldn't just connect people. It would erase distance. It would collapse costs. It would flatten hierarchies. Geography would stop mattering. Size would stop mattering. History would stop mattering. Anyone with a connection could compete with anyone else. And in this new world, any company at all, that carried the magical suffix .com was treated as if success were inevitable. Not probable. Not possible. Inevitable. At that moment, it didn't matter what the company actually did. Some sold books. Some sold advertising. Some sold pet food. Some sold nothing at all. What mattered was presence. Visibility. Speed. Because speed meant dominance. And dominance meant wealth. And it was inside this environment, this mixture of optimism, fear of missing out, and technological awe, that our central character emerged. The visionary entrepreneur. He was charismatic, confident, unshakably certain. He spoke with clarity in a world drowning in uncertainty. He didn't overwhelm audiences with spreadsheets. He didn't slow people down with details. He painted pictures. He described futures where friction disappeared. He spoke of scale without limits, of markets without borders, of growth without resistance. He didn't sell products. He sold inevitability. He made investors feel that hesitation itself was a mistake, that waiting was dangerous, that doubt was expensive, and the world listened. Before this era, capital was cautious. Money had weight. Investors asked hard questions. Banks demanded proof. Growth was incremental. Profit mattered. Cash flow mattered. Survival mattered. Building a company was a slow negotiation with reality. You tested assumptions. You failed quietly. You adjusted. Expansion followed validation. But the internet disrupted more than industries. It disrupted discipline. Or at least, people believed it did. Between 1995 and March of 2000, the Nasdaq Composite didn't just rise. It exploded. The chart didn't resemble growth. It resembled escape velocity. A straight line upward. No pauses. No reflection. No fear. People who had never owned a stock opened brokerage accounts. Day trading became a cultural phenomenon. Office workers watched prices instead of meetings. Students traded between classes. Taxi drivers offered stock tips. Financial television ran non-stop optimism. Traditional investors felt pressure to adapt. Those who stayed cautious looked outdated. Funds that ignored technology underperformed. And underperformance is unforgivable in bull markets. So they followed. Balance sheets were deprioritized. Losses were reframed as investments. Debt was reframed as fuel. Risk became a virtue. The dominant idea was simple and deeply seductive. This time is different. Technology had rewritten the rules. Old metrics no longer applied. Profit could wait. Market share couldn't. And the visionary entrepreneur understood this psychology perfectly. He spoke the language of transformation. He talked about network effects, about first mover advantage, about winner-takes-all dynamics. He argued that once dominance was achieved, money would naturally follow. The details didn't matter. The story did. And stories spread faster than facts. Startups with no revenue raised hundreds of millions of dollars. Companies without clear business models were valued as future monopolies. In 1999 alone, more than 450 internet companies went public in the United States. Many doubled or tripled on their first trading day. Paper wealth exploded. Employees checked stock prices obsessively. Options replaced salaries as motivation. Spending accelerated. Offices became extravagant. Marketing budgets ballooned. Hiring was aggressive. Burn rate wasn't feared. It was celebrated. Losing money quickly was proof of ambition. If you weren't expanding globally, you were thinking too small. If you weren't burning cash, you weren't serious. Caution became weakness. Pets.com embodied this mindset. A simple idea, selling pet food online. Heavy products, thin margins, high shipping costs. Revenue was growing. Losses were growing faster. In 2000, the company spent almost $1 in marketing for every dollar it earned. Yet its valuation exceeded $300 million. It had a sock puppet mascot, Super Bowl commercials, massive visibility. What it didn't have was a sustainable economic model. But at the time, math felt optional. Before the collapse, the visionary entrepreneur was everywhere. Magazine covers, packed conferences, endless interviews. He was praised as bold, as disruptive, as ahead of his time. Critics were dismissed. They don't understand technology. They're stuck in the past. They're afraid of change. Analysts justified impossible valuations. Multiples lost meaning. In 2000, Cisco Systems reached a market capitalization of more than $550 billion. For a brief moment, it was the most valuable company in the world. More valuable than firms with decades of proven profitability. It felt logical, until it didn't. Because reality never disappears. It only waits. In 1999, the Federal Reserve began raising interest rates. 6 increases between June 1999 and May 2000. Money became more expensive. Liquidity tightened. Quietly, almost invisibly, risk appetite began to fade. Funding rounds slowed. Valuations stalled. Some startups quietly reduced hiring. Others delayed expansion. And then, slowly, the forbidden question emerged. When does this make money? No one had a convincing answer. In March 2000, the Nasdaq began to fall. At first, it looked harmless. A correction. Then selling accelerated. Margin calls forced liquidation. Fear replaced confidence. What had risen on belief collapsed on reality. Within 2.5 years, the index lost nearly 78% of its value. Trillions of dollars vanished. Companies disappeared overnight. Websites went offline. Offices emptied. Pets.com shut down less than a year after its IPO. Webvan burned over $1 billion before collapsing. eToys, once valued at billions, followed shortly after. Silence replaced noise. The visionary entrepreneur was rebranded. Once bold, now reckless. Once innovative, now irresponsible. The same presentations that once inspired crowds became cautionary tales. Investors learned, painfully, that technology doesn't erase economics. Costs exist. Competition exists. Math exists. The damage was global. Markets in Europe and Asia fell. Pension funds lost billions. Savings evaporated. Between 2000 and 2002, an estimated $5 trillion in market value disappeared. Millions lost jobs. Entire careers ended. But beneath the wreckage, something remained. Infrastructure. Fiber optic cables. Data centers. Payment systems. The bubble had overbuilt. And that excess became the foundation of the modern digital economy. The internet didn't fail. Human expectations did. From the ashes, a different generation of companies emerged. Less flashy. More disciplined. Amazon lost nearly 90% of its value between 1999 and 2001. Many expected it to fail. But it had logistics, operational rigor, long-term focus. Google avoided the IPO frenzy. Built quietly. Executed relentlessly. They survived not because markets were kind, but because reality was respected. Now, look at the present. From 2020 to 2021, liquidity exploded again. Interest rates near zero. Trillions injected into the system. Growth once again became the obsession. Metrics replaced profits. Users mattered more than margins. Stories mattered more than sustainability. Then inflation returned. Rates rose. Valuations collapsed. The narrative changed. Again. Technology evolves. Human psychology doesn't. Hope. Greed. Fear. The dot-com bubble wasn't a failure of innovation. It was a failure of discipline. And that lesson never expires. History doesn't warn. It repeats. Quietly. Until it's loud. And the only real defense is remembering what belief sounds like before it becomes expensive.